Hi guys, I was just gonna do a quick video over our regarding sample portfolios. Uh, just a quick disclaimer: I am not a finance professional. I don't have a certified. I don't have a CPA. I'm not a certified public accountant. I don't have a CFA. I'm not a certified financial advisor. I'm just, a normal Joe posting on YouTube. So do your own research before you invest any money. The only credentials I have include, basically I've been investing 10 years on my own. I have self-directed accounts. I've read a lot of books on investing. Ones I recommend are some beginner books that I really enjoyed were the Boglehead books, so they go over kind of Vanguard funds. Another one I really enjoyed was ETFs for Dummies. Both of those are give a lot of kind of the basics. So I kind of taught myself by reading those. But those are probably two I'd start out if you don't know anything about investing. And, only credentials I have is, over the period of 10 years I've been investing, I probably have accumulated more than or earned more than 6 figures worth of passive income through both single stocks and ETFs, but mostly ETFs. So ETFs are basically exchange traded funds. You can think of them like they're basically a basket of stocks. And each ETF follows an index. So you can buy an ETF that follows the S&P 500 index. Those are basically the 500 largest companies in the US. There's also other ETFs that focus on, a dividend ETF where all the stocks in that ETF are high dividend, 2% or more sometimes. But yeah, those are kind of the basics. And then I'll just kind of list some portfolios that I like or that I think are interesting anyways. And just to give you some ideas, and then basically you do your own research and, put your money and buy stuff that you like. Okay, so let's start off with the most basic probably portfolios, what they call the 3-fund portfolio. Excuse me. And you can read more about this in the Boglehead books, which go over mostly Vanguard funds. Okay. Let's see. Sorry, trying to get my bearings here. So we'll call this 3-fund portfolio. So the first one would be something like a VTI. So VTI is what they call a total stock market ETF. And I'll make a separate video and go into more detail about each of these. But you can just, and all the funds or all the ETFs I'm going to mention here are basically low-cost ETFs. But I'll do a separate video that goes over, expense ratios, what actually makes up each of these ETFs, so you can get a little bit more information if you want more details. But this video will be more over just kind of basic portfolio ideas. Okay, so VTI would be the first one. So total stock market fund, domestic funds, so US companies. The next one would be something like a VEA. That's basically an international fund. So it's going to be pretty similar to VTI. large cap international companies. And then the third one of the three fund portfolio would be something like a B and D. So BND is basically a intermediate duration bond ETF. So you have to be a little bit careful with the bond ETFs. They're similar to bonds, but not exactly. So when you buy bonds, you're guaranteed the principal back plus whatever the interest rate or dividend is. So if you buy a bond, you're going to get principal plus your interest or dividend back at maturity date. Bond ETFs are a little bit different. They trade more like stocks, so there is a chance that you can actually lose money with a bond ETF because the price of the ETF goes up and down just like stocks do. But they are in general much safer than a bond ETF is much safer than a stock ETF. Theoretically, it should have less volatility. So BND is basically a basket of, I'll have to double check, I believe it's at least 500 different types of bonds, intermediate duration bonds. And I believe the dividend yield is about 4% for BND right now. So three fund portfolio, VTI's US total stock market, so 4,000 different stocks. VEA is international large cap. BND is intermediate bond ETF. So all three of these are ETFs. I might say fund, but interchangeably exchange traded fund. And then you can play around with kind of what they call the asset allocation. After you kind of learn a little bit more about that, read up on that. Asset allocation basically is deciding on what percentage of your money you want to put into each of these. So asset allocation depends on your age, it depends on your risk tolerance. So for example, for a younger person that has a lot of time before retirement, you can be more aggressive. So you might do either like 80% in stock and 20% in bonds. So, for this example, you might do, again, this is all subjective and it's going to be different for everyone. Excuse me. So I'm just going to give you an example. So say if you do 20% in bonds, then you'll have 80% left for stock. So again, I'm just making stuff up here. I would do, why don't we say 70% in VTI and excuse me, 10% in VEA. Or you could do, if you want more international exposure, you could definitely do 20%, 30%, whatever you're comfortable doing. Overall, VTI, I think the past 10 years does have a higher return than VEA does. And obviously, I believe both of those stock ETFs have had better returns than the BND or bond ETF. Okay, so three fund portfolio, that's probably one of the most, excuse me, simpler portfolios. If you want super simple, obviously, easiest portfolio would be one ETF. If you didn't want to mess with anything, you want the easiest ETF, I would just go 100% VTI. VTI, most, the average stock return is going to be about 10% per year. I believe VTI is probably right around there, but we can check, at the end of this video to make sure, period. Excuse me. Okay, so we have 3-fund portfolio. Easy portfolio is just VTI. The next one is, you can call it, or I like to call it, we can call this one lazy portfolio. So lazy portfolio basically would be something like a VTI, and maybe like a, so you have your stock component here, and then maybe like a BND. So you have your stock component here, and then excuse me, then you have your bond component too. So for a young person, you could do 80% VTI, 20% BND. So next portfolio we could do, if you want to be super aggressive, we can call it a high growth portfolio. So you could do something like VGT. Excuse me. So VGT is basically kind of a technology portfolio. So tech stocks. Majority is going to be tech stocks. And then you could also do like Schwab G is also high growth ETF as well. I believe VGT is mostly, if not all, tech companies. Schwab G is going to be a high percentage of tech, but it probably won't be all tech. It'll just be large cap growth US stocks. Both of these, I believe, are US stocks. So, for example, if average stock return in a year is about 10%, the growth stock's probably going to be a little bit more, so maybe 11, 12% per year. And then tech, who knows? Depends which tech companies we're talking about. But, definitely will probably be more than 12%, maybe 20% if you're lucky, but no guarantees. So, as with all investing, only invest with money that you can afford to lose. Okay, so that's high growth. So, again, depends how much risk you want to do, or how much risk you want to put into your portfolio. So excuse me. So if you want to go really balls out, high risk, you could do like 90% VGT and 10% large cap growth, or combination thereof for asset allocation. Then we could go totally opposite of that. So high growth basically is going to be, stocks that probably have a high appreciation, but growth stocks typically will have probably either low dividend or zero dividend. And so the opposite of that would be something like maybe a dividend portfolio. So we can call it dividend fund. So what I might do is something like a Schwab D. So Schwab D is, sorry for the coughing, guys. I forgot to get some water before I started the video. Schwab D is, I believe, mostly large cap US companies that focus on high dividend. The dividend rate for a Schwab D, I believe, is around a little bit less than 4%. And then you could do like, I don't know, maybe a BND. So Schwab D has about 4% dividend return. BND right now, I believe, is a little bit under 4% as well. So both of these are about pretty high dividend ETFs. So you have your, let's see, what else do we have? And then the last one I was thinking about, you know, the high growth, I didn't put a bond component because, you know, bond return is going to be less than stock return. So I think putting a BND in there would be kind of defeat the whole purpose of high growth, because bonds are not high growth and it's probably going to have a smaller return. And if you wanted to do maybe a bondless portfolio, so we'll call it bondless. Could do something like a VTI. And then for the bond component, you could do no bond, but you could do something more like defensive stocks. So in lieu of a bond component, we could do like 3 defensive ETFs. So defensive sectors, again, you can read about this in investing books, is going to be like healthcare stocks, utilities, and consumer staples. So we do like a XLV, which is healthcare. I believe it's large cap healthcare companies. You could also do VPU, which is utility stocks. And then you could also do like a, what are we missing? Do like a XLP, which is consumer staples. I believe they're mostly large cap companies as well. So the bond component would be 3 defensive stocks: XLP, XLV, and VPU. So defensive stocks are going to have probably a lower return than, say, a blended stock ETF or high growth stock ETF. So less volatility for defensive stocks. So for people that can't stomach the ups and downs of the stock market, but obviously you're probably going to have lower returns. So there's pros and cons of everything. So you'll have your stock. I mean, technically they're all stocks, but you can think of it as a little bit, total stock market's going to be a little bit higher growth. And then these 3 are going to be probably a little bit lower return, but also lower volatility. So you could do like, again, depends on your risk tolerance. You could do like 50% VTI, and then you know, you could split up the remaining 50% between these 3, you know, equally, or however you want. So those were kind of some interesting portfolios that I thought were pretty cool. Some of these some of these are pretty common, like the refund portfolio is covered in the Boglehead book. And then I think the rest of these I kind of just made up on my own. But there's, probably thousands of different combinations of ETFs and mutual funds you can put together. You can even, Google it or search the internet. I'm sure there's ETFs or portfolios that follow, politicians that are in the know probably of, what's going to happen with certain companies. So I found that to be kind of interesting. Yeah, so let me just review real quick. Three fund portfolio, lazy portfolio. I mean, the easiest is just basically one ETF portfolio. So I would do like VTI if you only want to invest in one thing, keep it simple. High growth portfolio, bondless portfolio, and dividend portfolio, high dividend portfolio. Okay, well, why don't I go ahead and stop here, and then I'll make a second video actually, and I'll go over each of these ETFs in more detail as far as expense ratio, how many stocks they contain, and things of that nature. Well, thank you for listening, guys. Take care.